Welcome back, dear students. Today we are learning about the second chapter, Banking Institutions. With session 7, we are going to learn more about foreign banks and payment banks. Coming to the meaning of foreign bank. A foreign bank is a bank with head office outside the country in which it is located. A foreign bank is a type of international bank that is obligated to follow the regulation of both the home and host countries. Because the foreign bank's loan limits are based on the parent bank's capital, foreign banks can provide more loans than subsidiary banks. Foreign banks are present in India either as representative offices or as branches. A bank may choose to open foreign bank branches to meet the needs of multinational corporate customers. Coming to the types of foreign banks. Foreign banks can either be branch or agencies, that is, representative offices in India, which are not actually a branch. Foreign banks often have correspondent banking relationships with domestic banks and provide a useful platform for foreign banks to access opportunities for foreign currency lending to Indian corporate and financial institutions. Coming to the eligibility criteria for having a foreign bank. There is an eligibility criteria on the basis of capital for a foreign bank to operate in India. A foreign bank must have at least 5 billion rupees towards capital on establishment. Also, a foreign bank must credit 18% of net ANBC, that is nothing but adjusted net bank credit, which is the total investment made by bank on non-governmental securities towards agricultural loans. Coming to their operational procedure. The foreign banks can have different modes of operations in India, as mentioned above, branch mode or subsidiary mode, which is known as WOS, that is wholly owned subsidiary. They can either start the bank branches in the initial setup or later convert them to WOS. To function as a wholly owned subsidiary, there are several factors to be met. One is the proof of economic stability and financial soundness to be provided by the bank. The bank must provide necessary documents to show the proper ownership. The bank must be rated by any international rating agency. Bank must have a risk management team. Then the market share of these foreign banks. Foreign banks account for less than 1% of the total branch network in the country. However, they account for approximately 7% of the total banking sector assets and around 11% of the profits. Most of the foreign banks in India are niche players, and their business is usually focused on trade, finance, external commercial borrowings, wholesale lending, investment banking, and treasury services. Some of other banks are confined to private banking and wealth management. As of November 2018, there are 45 foreign banks with 286 branches and 40 banks from 22 countries operating as representative offices. Although the discussion and differential licensing is still just coming into existence and beginning to display signs of future potential, there is one foreign bank present as a credit card issuer with limited banking license. In addition, a number of foreign banks have also entered India through the NBFC route, while a considerable number have set up captive centers in the country. Foreign banks have less than 1% of the total branch network, but about 7% of the total banking sector assets and a sizable 11% of profits. With 334 branches in all, the share of foreign bank branches is less than 1%. Next, we will learn about payment banks. Meaning of these payment banks: based on the recommendations of the Nachiket Moore Committee, Payment Bank was set up to operate on a smaller scale with minimal credit risk. The main objective is to advance financial inclusion by offering banking and financial services to the unbanked and underbanked areas, helping the migrant labor force, low income households, small entrepreneurs, etc. They are registered under the Companies Act of 2013 but are governed by a host of legislation such as Banking Regulation Act of 1949, RBI Act of 1934, Foreign Exchange Management Act of 1999, Payment and Settlement System Act of 2007, and so on. The main objective is to advance financial inclusion by offering banking and financial services to the unbanked and underbanked areas. The features of payment banks, they are differentiated and not universal banks. These operate on a smaller scale. It needs to have a minimum paid up capital of rupees 100 crores. Minimum initial contribution of the promoter to the payment bank to the paid up equity capital shall at least be 40% for the first 5 years from the commencement of its business. Activities that can be performed by payment banks. Payment banks can take deposits up to rupees 2 lakh. It can accept demand deposits in the form of savings and current accounts. The money received as deposits can be invested in secure government securities only in the form of statutory liquid ratio. This must amount to 75% of the demand deposit balance. The remaining 25% is to be placed as time deposits with other scheduled commercial banks. Payment banks will be permitted to make personal payments and receive cross border remittances on the current accounts. It can issue debit cards. Activities that cannot be undertaken by payment banks. Payment banks receive a differential bank license from the RBI and hence cannot lend. Payment banks cannot issue credit cards. It cannot accept time deposits or NRI deposits. It cannot issue loans. It cannot set up subsidiaries to make or to undertake non banking financial activities. Coming to the advantages of having payment banks. Expansion of rural banking and financial inclusion, expansion of the formal financial system, effective alternative to commercial banks, efficiently deals with low value and high volume transactions, access to diversified services. These are some of the benefits which are offered exclusively by the payment banks. When we speak about advantages, it becomes essential to also learn about the challenges faced by private payment banks. Firstly, lack of awareness among the masses to access these services, lack of incentives for the agents to involve themselves in these activities, lack of infrastructure and access to operational resources, and technological hurdles. So, in spite of all these challenges, payment banks are doing really good enough and they are learning to overcome the challenges and convert the same into their opportunities. Thank you, dear students. It was pleasure dealing with this topic of foreign banks and payment banks. Meet you again in the next session with further topics. Take care. Bye.